right, let's bring in our next guest analyst, Mr. Craig Milanos, to tell us what he thinks is going on out there. Craig, happy Friday morning to you.
Hey, Scott, happy Friday. What's not to like? Well, what have we done now? Some 6,000 points round trip, not around the sun, but on the Dow Jones Industrial Average. And I got to say, things aren't as bad as feared thus far as of the 16th of May.
I mean, it has been an historic week, I must admit, not including the V bottom off the lows of April 8th. But what happened over the last 5 days is pretty big.
I think lots of things are really big, and I think everybody just wants to know, can the rally keep going? Isn't that the question of the day as we all go into the weekend? Can the rally keep going? And my thoughts on that are probably the same I've shared with you the last couple of weeks when you've been gracious to have me on, which is, again, not having things as bad as feared is not the same as good. I want to remind everybody of that. I still view, based on valuations and other things, that the range on this market, that 5,100 to 5,500 I've talked about time and time again, is maybe fair value. So I do get a little bit worried, just a tiny bit worried, that we're extended here. Again, I don't think anyone needs to fear full-on cataclysmic bear market recession. No, those things are plausible. It's just much more probable that we sapped out economic momentum, and I need clarity with the 18 trading partners. I need 2 to 3 rate cuts, and of course, you got to pass the renewal of the Tax Cut and Jobs Act. You get all 3 of those, we're good. 2 out of 3 ain't bad. 1 out of 3, nothing works. That's where I sit on a Friday morning.
Yeah, I mean, you've summed it up perfectly. I mean, we've had a great week in the Middle East. You're right. We've got to get that big, beautiful bill done, and they're obviously going to be some rhinos that are, they got their heels in the sand. We'll see if they can get it across the line. I think they will, but not until Trump gets home and gets him on the phone. I also think that as much as I don't think the market needs rate cuts, we'll probably get one, maybe 2. But you have to trade what's going to happen, not what you think is going to happen. So I think that I think they shouldn't cut rates, but I think we'll probably get 1, maybe 2. You're right. But I also think that we're going to see some more of these trade deals, follow up behind China. China was a big one. Now, yes, they have to pound out the details. But I think there'll be some more people getting in line behind China. It'll be nice to see if we can get India to be the one of them that does it. But he's still going on about how many more countries are out there trying to line up, and I think the Middle East tour is going to put pressure on them too.
No, I think you're right. And, Scott, if I could chime in on something, you and I have done such a job. You've always invited me to give people some sincere and actionable ideas on your program. And you and I, over the last year, for all intents and purposes, I feel like we've talked about that value, about including bonds in your portfolio back when treasuries were great, owning some defensive sectors, meaning the value side of the equation, not just being reliant upon S&P 500, maybe equal weighting. But now I remind everybody that an area that far too many investors still have so little, if oftentimes no exposure to, is the international markets. And I encourage people to take a look at what's going here, because in the first quarter of the year, literally, international stocks beat the S&P 500 by their largest margin in nearly 40 years. And that is newsworthy, and it could continue.
Well, we definitely had some, anti-dollar sentiment. You saw what happened to the U.S. dollar and the U.S. dollar index. There's a lot of people that didn't want to have anything to do with us for about 3 or 4 weeks. Maybe that turns around, maybe not. But you're right. A lot of the markets outside of the U.S. have way outperformed the U.S. and the S&P 500.
I think that's right. And listen, I'm American Craig here. I am pro-America. I am red, white, and blue. But if we're talking about investing, I have to recognize that, number one, foreign stocks, they got the momentum. Number two, they're cheaper than everything in the U.S. on a PE, PB, PEG ratio. Third, their dividend yields are higher. And honestly, it just means they're potentially underinvested from an asset allocation standpoint for far too many people. So take a look, crack open that portfolio on a Friday afternoon, see what your international exposure is, and don't go gangbusters, but get a plan to be systematic, disciplined, and intentional to start getting a couple of dollars outside the USA while you still do your spending on things that are made in America.
Real quick before we go, how easy or hard is it for some of those folks that might be listening to get involved in those foreign exchanges?
I think it's relatively easy. I mean, listen, whether someone now doing it in local shares, Scott, that's not going to happen. But in this case, if you're trying to get retired and stay retired, I'm just talking about owning some dirt cheap, low cost, exchange traded funds, or for those who want some active management, a mutual fund or a separately managed account is easily accessible through most programs or fantastic wealth managers like Vestgen Wealth Partners, Scott.
All right, brother. I'm glad you got that in there, and we're going to end on that. Great stuff as usual. Have a great weekend. Craig Bolanos, he's a co-founder and wealth manager at Vestgen Wealth Partners up in Chicago. We're going to go away. We're going to pay some bills. We'll be right back right after this.